Last week, the Fed Chair Jerome Powell hinted that there could be some interest rate cuts in the very near future, as early as next week or even the end of this week. However, inflation, last I checked, is not done yet because we still have tariffs, and there is something called stagflation that is a major threat to the economy if you start to lower rates. So why in the world would you consider cutting rates, and what is the potential damage or even upside to doing this right now? Let's go ahead and break it down. So I'm going to cover this from about 3 different angles and give you the pros, the cons, and the definitions that you are going to need to know, and obviously what you want to do or consider doing as an investor. So first, why? Why would you even consider cutting rates? The first one is the president wants you to, and the president is threatening to cut your job if you don't cut these rates. Now, traditionally speaking, and this president obviously is not traditional by any sense of the imagination, traditionally the Fed is supposed to be independent and is not supposed to care or do anything that the president says. But again, wild times, okay? But he's threatened a lot of things against the Fed, including getting rid of one of the Fed governors. I'm not going to get into how the whole Fed works, but that is a part of that. Now, I don't think this particular rate cut is a huge thing because there have been people who have predicted the Fed to cut rates. I've been talked about way back in January when I did my 2025 masterclass about what to do for 2025. There was a potential of a rate cut back then, okay? So this is not novel information. However, the economy is slowing down by some measures. Yes, unemployment is low, but it is taking longer to find jobs. We do know that inflation is creeping up, and then we all know the whole kerfuffle around the jobs report in that we thought we were hiring a lot of people. Turns out we were not. So there are not enough job openings, or not a lot rather. And then again, as I mentioned, taking longer for people who are out of work to find work. That's not necessarily helpful. And then also we are seeing currently spending start to slow down. So they're saying, all right, look, if we cut rates, the hope is, and what has usually happened in the past, but there is an asterisk here, what happens in the past, you cut rates, people start to spend more, maybe housing can pick up just a bit more, and that is the hope. Except that this case is a bit different because we have tariffs here in play, and that's the part that we need to get here too. So what is the impact of this and the impact in context? That is the important piece here, okay? It's always impact in context, because 2025 is different than what it was in 2020 when they were cutting rates aggressively, right? The context there was a pandemic, right? Last time we were cutting rates before that, the context was 2008, right? So it's always what is going on with what else is happening in the world and in the country. Let's start off with the cons and then hopefully end up on what we hope to be a positive. But the thing here is, if you lower interest rates or lower them too far, which the thing is we don't know what is too far, otherwise we'd have done it already, okay? But the thing is, you lower interest rates, you encourage people to spend, and that has always been the case. Because right now, for instance, a high yield savings account, you can get roughly 4%, all right? And the incentive is, I can risk almost nothing putting my money in a savings account, getting 4%. I can sit here, get 4%, and the market on average, right, gets you right around 7%. So I can sit here and get 4 and not have to risk putting my money in the wrong stock or risk putting it in an index fund and it might not do what I need to do in that particular year. I mean, think of how bad the market was when they were announcing these tariffs and the market fell apart, right? Well, I could have had it an index, not an index fund, a savings account, and got 4% and not have to worry about that entire thing. And my money could have been flat, easy, and stable. Well, if the Fed starts to cut rates, that interest on your savings account starts to drop too. And that says to the saver, for some of my money, you guys want to continue to have your emergency funds, but that says, all right, well, maybe I need to go and take a bit more risk to get more return because I want to continue to beat inflation, right? Well, if it's at 4 now and they start to cut and it eventually goes down to, so if it goes back down to 1% at some point in time, I don't think they're going to cut that aggressively, especially not that quickly, but there was a point in time where savings accounts did only pay 1% or 1.5%. That happened in my lifetime, not too long ago. But in either case, if that starts to happen, then you are going to have to take more risk. You are going to say, all right, I need to beat inflation. I need to put more into the market. I need to, I don't know, start a business and invest in different things. That is what they want you to do. They want to encourage you to spend. Well, if they do that, if you start to push more money into the market, what is the definition of inflation? Too much money chasing too few goods. We learned this back in 2021, 2022. That was what everybody was saying on the news, and that is what your economics textbook is going to tell you right now. Too much money chasing too few goods causes what? Inflation. Right now, we currently have inflation. It may not be as bad as what we saw in early 2022-ish when it was around 9%, but it is still above 2% currently, which is not what the Fed wants. So what happens if you lower interest rates, cause more inflation, and then you have tariffs on top of that? That is an issue, and it's something that I have said in this video has been my main concern. Not necessarily a recession, but something called stagflation. This is something that economists are deathly afraid of, something that I have only read in economic textbooks because that's what I got my degree in, and something we don't truly have an answer for, because when stagflation occurs, that is basically when we as a consumer economy say, all right, look, we're not spending because I keep seeing prices go up because the Fed cut rates, people are trying to spend, and I'm starting to see inflation, and then we're also not spending. So the economy is shrinking because we're not spending, and prices are still going up because of tariffs. And you're getting high prices, people not spending, and you basically have a recession, but also high prices at the same time, and you have those two forces moving in opposite directions. And it is a weird place, because how do you fix that? You can't lower rates because then you're going to cause even more inflation, which is why I said that I don't know if cutting rates is the smartest thing. And the cycle kind of goes back and forth, and that is a primary concern. And then you have this, right? There are some people that say, well, what if they only do just one rate cut? They just cut rates one time at 0.25%. That is the main expectation, especially for this year. My concern here is, how do you know they only going to cut rates one time? You don't. Nobody actually knows, and especially because of the pressure that the president has. Does anybody know? And it's not a political statement or anything, but it's just reality. We saw the president get fired because of the jobs numbers. We have seen him buy Intel, right? 10% of Intel just because he feels like it. And we'll talk about that later this week. But how do you know that this isn't just going to be a one-time rate cut, whether you agree with it or not? I think one-time rate cut of 0.25, I don't think it's going to ruin the economy. I don't think that's going to push us into stagflation either. But how do you know it's just going to be one? He's been begging for interest rate cuts for at least a few weeks, if not a few months now. How do you know this is not going to be just one? He's not going to push it further and further until we can't cut anymore. I don't know. And I don't know, nobody truly knows how many rate cuts it's going to take to push us into a much worse scenario. We don't have an answer to that. We don't. No one truly knows. You never know until it's too late. You never know until you're in stagflation. You never know until you're in a recession. And we don't have the Bureau of Labor Statistics in the way that we used to truly measure those things in the best way possible. So those are the cons. But speaking of the pros, one pro is going ahead and hitting the subscribe button so you can be alerted of these videos as we go throughout the year. So go ahead and do that, and then we'll talk about the pros of this particular move and how it may be able to help you. So the first thing is, this can be a very good thing for the stock market. Once this was announced on Friday, I forget the exact number, I want to say like 300 points that the market jumped. The market, I think, will respond in a very positive manner, though this was something that was expected. Generally speaking, lower interest rates do help businesses, do help companies, because it allows borrowing at a cheaper rate. They borrow more money, they hire more people, they grow faster, right? Which means the stocks typically go higher. That's not a guarantee every single time, but that's usually good for investors if we continue investing. But again, this is kind of goes back to, not to be negative here, but this kind of goes back to the part where I say, well, if that's the case, and that's like everybody, you want more money if you are an investor. You get one rate cut and you see the market go up. Don't you want more? You're never just going to stop at one. You get one, you say, ooh, I made 10%. You're just gonna stop at one? No, you're gonna want more, right? So anyway, that is one good thing for investors. Now, the other impact of this is anytime you cut interest rates, you're usually gonna see a lower rate on your savings. So you do wanna pay attention to that. If you're not already in an HYSA, high yield savings account, do pay attention to those. You are likely, I can almost guarantee you are going to get an email from your bank within 72 hours of that announcement, if not before, saying, hey, we are going to lower your rate. Don't panic. It is something that is expected. I'm telling you now, I'm not telling the future, I don't have a crystal ball, but I'm telling you now that's likely going to happen, that you are going to see that, and you can either A, decide to shop around and move to a different bank. I don't always think that's the case because they're likely all going to go down to a degree, but it is good to kind of know what else is out there if you choose to. And that is an invitation sometimes to say, look, I was getting 3% here, but actually somebody is paying 3.75. That difference might be worth it to you, but do pay attention because you can move there and they can lower it the second you get over there. So pay attention to those. So there's an opportunity to you. But again, investors are usually going to win. Also pay attention to dividend stocks too. If you are someone who is seeking that income, that might be an opportunity for you to get a little bit of extra income depending on what stock you buy and how quality that investment is. If you are a bond investor, interest rates and bonds have an inverse relationship, meaning when interest rates come down, bond prices do go up. So those might become more attractive as well. But really depends on, again, if you are someone who buys bonds and if that's something you're truly into. Honestly, I don't find too many people into fixed income and bonds, but you know, those are some people out there. And if you are, and usually these people closer to retirement, that might be something that is attractive. So the stock market usually goes up. Usually bonds tend to be a better space to be, just like holding those bonds becomes more valuable. And then look for your savings to drop just a bit, which means you might want to consider taking on more risk. This does not mean that we are out of the woods yet. My other concern, again, as I mentioned before, is how many cuts are we going to make and what is stopping us from being prudent and only just cutting once. If you want to know more about how I'm looking at the stock market and what stagflation means for the entire economy and the risk of it, then you want to check out this video right here.